Thanks for tuning into Talking Point. I'm your host, Niraj Shah. And, well, on a reasonably good day for the markets, the case for a chat with our guest today on Talking Point will come up on your screen. Will Q1 results moderate valuations? There are a lot of expectations about the numbers actually slightly better than what was estimated. Could they actually help in valuations looking a tad bit better than what they might be looking right now? Let's see. We'll ask our guests. Policy unlikely to aid consumption or policy likely to aid consumption? That's the biggest debate, and almost every second day we'll be talking to a guest to try and understand how to play this. So that's the second point that we need to figure out. And whether there's a room to grow for the cap goods stocks, because on the valuation basis, these guys are very expensive. The question is, can they do more? I think all of this and more being posed to our guest today, Dinshaw Irani from Helios. He joins in right now on the show. Dinshaw, great having you. Thanks for taking the time out and being with us on Talking Point today. Can I start off by asking you, how do you feel about the markets currently? Because there's a lot of divided opinion about whether the government can meet the fisc and capex plus some consumption aiding measures, the troika of all three, and whether that can be done. And if it can't be done, could it impact the market sentiment and multiples at large? How do you feel about it?
Neeraj, very good morning to you, your viewers, and your team. And thank you for having me on your show. So, Neeraj, here's the thing. The fact is that the market, I think the government's got enough and more to do what they have, because they already have this additional surplus of around 1.5 lakh crores, which they received from the RBI. So they've got enough in their kitty. So we'll talk about that later. But having said that, on the markets itself, I don't see any major negative news or any positive news, in fact, also till the time of the budget. I think the budget will lay down a specific trend for the market, given what the policies will come out there. But the fact is that you may see the market being in a tight band up to the budget. And from there on, the move could be either ways, I mean, depending on this. Because frankly, I mean, on the valuation front, the large caps are more or less, I obviously looking at history, they're expensive, but our belief is that the world has re-rated India, and that's why that 20-30% premium to what history had already, rather a 20% premium to what history was giving us on the large cap side. However, having said that, the mid caps looks totally stretched. I mean, our feel is that with a 60% premium to what the large caps are quoting at, they're fairly stretched. I mean, normally, if you see the last 10 years averages, it's around 20% premium to the large cap valuations that the mid caps are normally quote at. But this time around, they hit 60%. And because I think the pool is too small. The pool of 150 stocks having to absorb so much money, which goes into the mutual funds, that is creating a problem with that valuations. And on the small cap side, I think they're more or less par with the large cap. So maybe, I mean, if you look at history, they were at 10% discount to large cap. So I think they're more or less there, but yeah, not at that shit. So having said that, maybe you'll see some kind of correction coming in the mid cap space. Otherwise, I don't see much happening in the other sides.
There's Dinshaw, there's this interesting set of companies that are getting unearthed. I mean, Goldman yesterday wrote a note on a company which is a B2B aviation airline company as well, talking about a possibility of a free cash flow to PAT ratio of 100%, EBITDA CAGR of 30% for the next 6 years. And there are multiple such notes that have come out in the recent past. I'm just trying to understand, are the range of opportunities available in the market currently a very wide set? Because we usually talk about sectors and themes, but there are a lot of stocks which are just one or two in the sector. Zomato, a case in point, the only listed play out there, and we'll talk about that a bit later on, of course. But I'm just trying to understand, is the opportunity set very wide at the broader end of the spectrum?
So basically, Neeraj, I mean, the company that you talked about, basically it's a platform company. And frankly, I mean, what the other guys do in the other spaces, he's doing in the travel space as such. So that's what our feel also. And all these brokers are coming out with that report. I mean, that one particular company, because I think that 45-day lock-in got over after the IPO. So maybe that is what's happening there. But I mean, obviously, we are also sanguine on that fact that you have to look at valuations given the growth opportunities that are there in the market. I mean, Zomato that you mentioned, that company, we love that company because we've seen that globally. I mean, globally, it's a very established model. And the fact is that there are only two players globally in every single country that you can think of, right? So it's the same being replicated out here. And that's why we like that. And given the opportunity that company offers, it's obviously going to be huge. So you got to be very clear on which uh, segments are going to appeal to you, which sectors are going to appeal to you before you take a plunge into these newer names as such. And obviously, valuations is one thing that you need to keep in mind. And obviously, with a backdrop of whether the opportunities that they offer, the growth opportunities going forward, are looking exciting or no. So that's what you got to keep in mind, Neeraj. Though you see a lot of variety coming into the market today. In fact, as I told you last time also that we're looking at a financial services fund. We shut our fund last week, and the fact is that financials still not so long backs were being thought of as only banks and NBFCs. Look at the variety which is available out there, and that is what is exciting us about that sector itself. So yeah, I think India's the more India grows, the more variety you'll see coming in.
Okay. Dinshaw, there is some talk of how there's a technical note today from one of the brokerages which speaks about how IT stocks could actually have a run-up ahead in the run-up ahead of the results, right? Accenture numbers were bad, but their comment around the AI generative deals and maybe some others led to that stock flaring up. IT is not at a bad time since then. My question to you is, while the valuations aren't exactly cheap, are the negatives baked in, or do you reckon it's still some time away?
So, Neeraj, the fact is that, I mean, you're right in the sense that I think the valuations are more or less done and dusted. So maybe we won't be carrying any shorts in our books, but that still would excite us to go for a long in IT, frankly, because, I mean, even Accenture, right, the numbers that they showed up were basically, they showed growth in Japan, where we are almost not present. I mean, the Indian IT guys are not present. They showed growth in government-run services in the US. Again, we are not present there. So it was fairly a very concentrated pocket where the growth came from, and that didn't excite us much. But obviously, looking at the way the stocks have done in the past, I mean, they have in fact corrected when the market has moved up. So it's obvious that relative to the market, their valuations have become fairly now down to probably sensible levels, but still not excite us because we don't see much growth coming in. Your AI that you talked about, it's a very limited portion for most of the IT players in our services guys in India, sir. So that's we're gonna keep it on the back burner as of now. I don't see much excitement in that sector in this particular fiscal year, that is FY25. Maybe we'll take a call closer to the end of this fiscal, looking at what the growth rates are looking like when they meet the managements and they get a feel of how US is panning out.
Okay. Well, let's talk about some newsmakers and try and see what Dinshaw thinks about them as well. But Amara Raja is in spotlight for sure, up over 15% right now after the company's arm inks the licensing pact with GIB Energy X. Let me first get in my colleague Puneet to give us a very quick perspective on the importance of this for Amara Raja, maybe for the battery space. Puneet.
Yeah, thanks for that. So, as you rightly said, it is a strategic partnership for exchanging the technology for lithium-ion batteries going forward with GIB, which is Goshen Innovat Batteries. Now, what will GIB essentially do is license the technology to Amara Raja for manufacturing lithium-ion batteries right here in India. This will enable Amara Raja to manufacture lithium-ion battery as well as the cells for the same in both forms, which is cylindrical as well as prismatic, both used currently in India. Now, why is this particular pact significant? Is as it provides cell technology, intellectual property to someone like an Amara Raja. I do know that the management has been highlighting of talks going on in this particular space of with global players to license the technology and get it in India as well as manufacture the same. This will also support currently the gigafactory that Amara Raja is building in Telangana with an outlay of roughly 9,500 crores. The first phase of the commercialization is expected by the end of FY26. So this particular particular tie-up will also help the technology transfer to Amara Raja going forward as well. When you look at, what's interesting is that this is of course a joint venture of GIB, which has the Innobat as well, and Amara Raja currently owns a 9% stake in one of the partners of this particular JV as well. So this could be a multi-year opportunity going forward as well. The management has highlighted that they've been looking at it for a while now, and they want to have a partnership with someone who has an 8 to 10-year view on this particular sector, so that any kind of technological changes can also be taken care of going forward as well. Finally, just one last bit on valuation. We've seen Exide run up significantly since March this year after their tie-up with someone like a Hyundai for batteries, currently trading at 36 times, and Amara Raja was much lower at 22 times. So the sharp run-up today is also one of kind of like a valuation catch-up, so as to say, and more details will be averted going forward as well, but really significant partnership, at least for today, for Amara Raja. Back to you.
Thanks, Puneet. Dinshaw, a hot pocket now, right? Amara Raja, rather exciting, this pact with Hyundai and Kia. Amara Raja now does this battery pact with a large company, presumably some more in the anvil with auto OEMs as well. This space was completely absent in India. Is this the sign of it getting formed now? Lithium-ion battery with the two incumbents, does it improve the multiples? Does it make noteworthy, or are the valuations too stiff?
So, okay, the point is, by the way, we don't own any of these companies, so I will, my negative views are obviously my own, and everybody should treat it accordingly. So the fact is that one thing, by the way, lithium ion is, because lithium is such a scarce commodity, there's already work going on sodium ion batteries now. So that's one shift that the industry may be seeing very shortly as such. And maybe that is why the international guys are more keen on tying up with companies and letting their technology go, which they were which they were keeping earlier very close to their hearts as such. So I don't see that to be exciting part. And frankly, I mean, what is the USP that we bring to the table? Because anyway, these are not labor intensive industries, right? They are very capital intensive industries, and obviously capital in India is not cheap. So there's no arbitrage out here in terms of labor also that can be played out. So maybe we're just trying to replicate the world as such. And frankly, I mean, I don't see much of an option. I mean, other optionality out here of getting into a stock as such. So that's why we are fairly away from these things.
Okay, but before we hit that break, Dinshaw, auto anchs per se, I mean, leave batteries out, select other pockets have had a really strong run. Some linked to, I mean, some now might not just be pure auto anchs because they're doing defense, they're doing railways, so on and so forth. What do you like in this pocket if you do?
So basically, you said it, Niraj. I mean, the fact is that they ran up because of other options rather than purely being an auto and in the ICE space, right? So that is where the excitement is, and that is what we are also looking at. Frankly, I mean, our belief is that the auto space itself will go through a lot of upheaval thanks to the shift to EVs. And frankly, I mean, EVs is a different platform, though it's substituting your product, the ICE product. But it's a different animal altogether. It's a different platform altogether. You're talking about electronics out here while you're talking about mechanical out here. So they're two different things. There's no after-sales service in EVs. It's mainly uploading software. So it's a different ball game for the existing ICE guy to survive in that environment or to adapt to that environment. It's going to be a tall order. So that's why we'd rather be on the sidelines, see this play out, and then probably take a call later.
Remember, they're on the cusp of launching a BFSI fund, if I'm not wrong. I mean, I don't know the nomenclature, but it's essentially a financial services fund. And he's been constructive on that aspect. Then, Dinshaw, I want to take that conversation a bit forward on the non-lending financials, because we've seen SEBI activity on brokers, on AMCs, on platforms, etc., leading to some bit of moderation at times, right? Now, my question to you is, it's a great runway of growth. These businesses, even your business, will do really well, I'm sure, over the course of the next 10 years. Does this heightened flow of activity from the regulator dampen the valuations a little bit, or you don't agree?
Okay. One correction, we shut our financial services fund on the 14th.
I'm
So
so
now
sorry.
it's
Okay.
open. Today it opened for subscription. So
Okay.
that's okay. That's fine. So there was the first day today when the will come out. But anyway, having said that, actually, I think the regulatory actions are obviously needed in our industry because, frankly, I mean, you need some control, right? You're running a fiduciary duty of managing other people's money, so it's obvious that the regulator has to be honest to us all the time. And really, I mean, if you talk about the mutual fund space, there's hardly any. I mean, one or two here and there issues are happening, but that's about it. There's not much here because it's fairly well regulated, and that's why it's fairly very well managed also as such. So that we leave out of the space. Having said that, even on the non-lending side, you talked about brokers, you talked about exchanges, and obviously custodians and stuff like that. I think they're doing a wonderful job too, because I mean, you look at the fact that India is gonna grow GDP, probably the fastest growing GDP in the world in the next 4 or 5 years, right? Every year, that is what we're talking about, or what we feel will happen. If that happens, you're talking about per capita is moving up sharply, and obviously, when that happens, there's a wealth effect which kicks in. So all these companies that I talked about, not companies, sectors that I talked about, are mainly the gatekeepers to wealth, right? I mean, that is what we were excited about in the financial services space. As I said, that everybody thought it was only lenders in the space. There are actually other ancillaries, which are like 13, 12 or 13 odd ancillaries, which are really working in that space. And I think that is one space that we are fairly excited about. Obviously, we'll be very careful on the valuation front. And frankly, I mean, wherever there's a lot of aggression by the player, whenever it's a regulated space, you got to be careful in that space. I mean, you got to be careful with that aggression. So that's why we'll be very sanguine on that fact too. And we've been very selectively investing our money that we've raised. And I don't see a problem in that sector because our belief is that the sector will grow far higher than any other sector for the next 5 years at least.
Got it. Okay. Let's talk about other sectors too. And remember, we spoke about platform companies slightly with Dinshaw Irani. The news that has come up is I think Swiggy's performance and the brokerage views that have come out on Zomato. So before I get in Dinshaw's thoughts, not necessarily on Zomato, but how the business is looking and on the stock, let me just very quickly get in my colleague Mahima to tell us what brokerages have said about Zomato. Mahima.
Right, so just to give a context, Process, which holds around 32.7% in Swiggy, has come out with data for calendar year 23 for Swiggy on its operational performance. Now, on back of that, brokerages believe that Zomato has an edge over Swiggy. Now, CRSI maintains a buy with a target price of 248, which suggests an upside of 28%. Now, they're saying that Swiggy's overall gross order value was at 26% versus that of 36% for Zomato. In terms of revenue growth also, Zomato's revenue grew by 56% YOY versus that of 26% for Swiggy. And lastly, in terms of the dark stores, that is the quick commerce platform for both the companies, Swiggy Instamart has 487 versus that of 526 dark stores for Zomato. In terms of MK maintains a buy with a target price of 230 with an upside of around 16%. They're saying that Swiggy's IPO is now a key milestone, with valuations being the main monitorable. Then we also had a Goldman Sachs report on Zomato, which maintains buy with a target price of 240 and upside of 21%. What they're saying is that Zomato's market share is now 56 to 57%, which is 200 basis points higher than that of the previous period. And what they're saying is that Zomato is ahead of peers in terms of profitability, and this will continue to create opportunities for Zomato for further market share gain. Lastly, Kotak Institutional maintains buy with a target price of 225, which is an upside of 13.6%, and they're saying that the higher growth from Instamart could have diluted the overall take rate for Swiggy. And in terms of dark stores, again, they're saying that Blinkit takes over the Swiggy Instamart. And lastly, Swiggy is number 2 quick commerce player from a dark store counter perspective. So this is the overall view of what brokerages are making out for Zomato.
Thanks. And Dinshaw, come in. How you've told us that you've looked at these businesses globally, how it's a duopoly in most markets. It's turning out to be that way. But within the duopoly too, and these numbers may change, of course, but within the duopoly, the listed player seems to be finding an edge on the basic food delivery business, and then there are add-ons which are known like Blinkit, and then there are some more add-ons which are not even known as yet about the efficacy, but might get proven too. I'm just trying to understand, when you look at a business like this, how do you look at it? Do we look at it from a quarterly numbers perspective, or do you ignore those and think about the bigger picture story over 5 years or 10 years, what have you?
Yeah, you're right. Actually, you look at the potential of others. So basically, one thing that you be very clear about in these platform companies is that globally there should be an established model in this particular space, right? And we've seen that. And secondly, in the food delivery business, it's the number one player is always has a upper hand over the others. Look at the US, for instance, DoorDash. 60-70% of the market share being controlled by that one company. I'm talking about food delivery. Or you look at China, Meituan, again, some 70-odd% being controlled by that one particular food company. The second player is a marginal player, around 20-odd% in both the markets. So it's obvious that in India also, Zomato was probably the lead player who came in the space. And I'm not saying that they'll go to that level, but Swiggy is a tough competition to beat out here. So our belief is that India, the market is good enough to have two players and totally growing at a very fast clip. I mean, you're talking about what right now? I mean, 2 odd crore regular food delivery guys who are using that app and stuff like that, which is nothing. It's just not even the tip of an iceberg right now for the potential that these guys carry. So you got to look at the potential too. And the fact is that path to profits is very clear for these guys. I mean, they just have to, capitalize on rather encash on some of the delivery modules as such. And that's what I think Zomato's done very well as such. Swiggy is still having a problem because Swiggy is having some losses, still showing some losses going forward as such. So that way. And one more thing that you should keep in mind, Niraj, is that in the case of Zomato, Blinkit is a separate platform altogether. It's not a part of the Zomato platform, right? There are two different platforms. While in the case of Swiggy, it's one single platform for the Instamart business. So still it's not clicking that much, means that Blinkit is really getting a separate traffic altogether. So that's what's an exciting other opportunity, I think, for Zomato to come forward. That's why, all in all, we think we got a winner in this. And we'll stick on to that as long as the growth is exciting out there.
Yeah. Not a recommendation, viewers, remember, so please, this is great of Dinshaw to just spell out how they think about it. Dinshaw, my final question really is, where is it that you are skittish currently on valuations or otherwise?
So basically, Niraj, I think consumption space and specifically staples or FMCG, if you will, I think that is one area which is really concerning to us. We've not seen, though companies have talked about green shoots, but those green shoots are in the rural markets, and in fact in the cities and metros and all, that consumption space is going down. So that is a concerning part, because that can really drive down valuations also going forward for these guys, where they're already at stretch valuations. Another area of concern for us is paint sector. I think, again, apart from the paucity of demand right now, the amount of new players which have entered, it's going to create a lot of mess, and valuations again here are very stretched. So that's another area of concern for us. So there are only specific pockets, obviously in the PSU space. Railways is definitely looking stretched to us. Different certain pockets are looking stretched to us. So there's a lot that is concerning and very little that is exciting us today, I suppose.
Got it. Dinshaw, so good having you. Thank you for your time and your insights. Lovely talking to you as always.
Always a pleasure to be here.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.